All right. Good afternoon and welcome to 2020, a wake-up call for retailers and the road ahead. SierraConstellation Partners Holiday Retail Webinar. I'm Tammy Levine, SCP's Marketing Manager, and I want to thank you all for joining us today to discuss the state of retail, the pandemic's impact on this industry and holiday shopping season, and how some are pivoting in this environment. Shortly, you will hear from our retail and restructuring experts who will discuss what they are seeing that is working and potential options for struggling retailers to turn around their businesses. I'm pleased to introduce Katherine Doherty, a corporate finance reporter for Bloomberg News, who will be moderating this discussion. At Bloomberg, Katherine reports on distressed debt and restructuring news from their New York City bureau, covering recent major retail bankruptcies like J.Crew, Neiman Marcus, and Tailored Brands. Thank you, Katherine, for joining us today and introducing our panelists.
Thanks, Tammy. Good afternoon, everyone. Thank you for joining. Before we dive in, I want to start by saying this panel is meant to be a fluid conversation. So we encourage you to submit your questions at any time during the discussion. So we will not be holding a Q&A portion at the end. Rather, we'd like to hear from you as topics come out throughout. So the questions can be submitted through the Q&A pop-up that's at the bottom of your screen. I will monitor this function throughout the allotted hour to make sure that we cover as much material as possible. So now let me introduce the experts. First, we have Tom Lynch. Tom is a partner, senior managing director, and head of Sierra's Boston office. He has over 2 decades of experience in restructuring, recapitalizations, M&A, and secondary market transactions. Prior to Sierra, he was co-founder and managing partner of Woods Hole Capital. And for that, he was the chairman and CEO of specialty apparel retailer Fredericks of Hollywood Group, where he led an out-of-court restructuring. And next we have Nevin Shetty. Nevin is a managing director at Sierra with a background in financial services, technology, and retail. Prior to Sierra, Nevin was a chief partnerships officer at David's Bridal, focused on the digital transformation. And then finally, we have Isabella Montani. Isa is a senior associate at Sierra's Houston office. She has experience across industries, including e-commerce, oil and gas, agriculture, technology, apparel, food, and beverage. Before Sierra, Isa was a senior associate at Endeavor. That's a global nonprofit and an analyst at Tablet Quality Engineering Division at Dell Computers. All right, so let's dive into the material now that we have our experts. Tom, set the scene for us. Retail 2020 has been a historic year, riddled with disruption across all industries, and retail is not immune to the challenges and changes. So where were we headed before the outbreak of the virus? And where are we headed now that we're more than 6 months in?
Sure. So directionally, the business had recognized, I think, where the industry, we'll talk about retail here specifically, had identified where it needed to go. So there were some fundamental shifts in consumer buying behaviors and preferences, and companies were starting to react to that. So the companies that were slow to adapt, the e-commerce strategies, and the multi-channel strategies, and frankly being agnostic as to how the consumer chose to engage with them, directionally things were moving in the right way in that regard. In terms of low profitability, high cost brick and mortar stores, a lot of talk about closures. There were a ton of closures, typically at the high end. That was moving, not in our estimation as fast as it should have been. Consumer sentiment was fairly positive. Employment numbers were strong. I think we were getting into an area where we could have some predictability and demand, and coming into the seasons like this, there would probably not be any surprises, and we had some decent momentum coming. It crashed. It didn't slowly grind to a halt. It crashed. And what that caused really was a massive, unprecedented acceleration of all those things I talked about, and the urgency of getting those things executed as quickly as possible. They became not must-haves, right? Because they weren't that important. They became existential overnight. And that's where we sit. That's where we sit today. So the trends were generally positive, with a lot of work to do. I mean, we're just retail in particular was a distressed, has been a distressed place because there was just some secular shifts, but it's been turned on its head, as everyone knows.
Mhm. So 2020 has its winners and losers in the retail space. Isa, which retailers have you seen successfully pivot or benefit from this moment in time? And are there others that have fallen behind?
Yes, so I'll actually start talking about the losers because even I agree with Tom, the trends were going positive, but it's no news to anybody that some retailers have been struggling for a while. But since the pandemic, new trends have emerged, and one of them is focusing on essentials. And it makes sense. Customers are prioritizing their spending on essential stuff and avoiding discretionary items. So with this in mind, one of the biggest losers, or some of the biggest losers of these years, are definitely department stores, apparel, and footwear retailers. And it shouldn't be a surprise for anybody because these guys were already struggling with mass discounting, consumer changes, and competition in the off-price and online department. And B, most department stores carry large debt loads and rely heavily on in-store transactions, and sometimes to the extent that e-commerce cannot even bridge the gap. And also, if you think about Kohl's, Nordstrom, JCPenney, all these guys rely on apparel for the bulk of their sales, and no one's really preparing for a pandemic by buying jeans. That being said, another industry that has taken a hit, or an early hit, was the restaurant industry. And, they've been trying to recover losses by doing like curbside pickup, takeout, and some other inventive strategies, but they've been recovering a little bit. And that takes me to the winner side of it, because even though people have been avoiding physical stores to avoid or, stay away from the exposure to the virus, people still need to eat. And that's why we see all these grocery delivery services like thriving. So other than that, winners, of course, the mass merchandise like retailers like Amazon, Target, Walmart, Costco, they were not even struggling before. They were winning before the pandemic, and now they have a huge head start on everybody else. And here's the thing, for me, running a successful retailer means executing on the things you can control and praying that the things you cannot control work out on your favor. And I think that's the case for a couple of other sectors that benefited from the pandemic. So for example, home improvement, like people staying at home, they want to make it, they're saying, I'm spending more time here, I might as well make it nicer. Number two, stay at home, sales of at home fitness equipment. This is another trend that we've seen. We see the crazy Peloton madness, athleisure going with that. And if you give a girl a pair of leggings, she'll want a spin bike to go with it. So, like I said, Peloton dumbbells have been sold out for a long time. Personally, myself, I've been trying to get a reasonably priced 20-pound kettlebell, but I haven't had any luck yet. And if you see the trend, the most offensive non-food categories are those that have created some sort of household comfort with all this time we've been spending indoors. So if there's one thing I've learned through the pandemic or through a crisis, is that we're constantly reminded that some retailers are more vital to the everyday life than others.
Interesting. So Nevin, let's bring you in here to talk a little bit about e-commerce, which is another shift, which was already occurring, but even more important today. So where we are now, and from what you've seen, has the pandemic sped up the transition process for e-commerce?
Absolutely. COVID has accelerated all the digital trends that were already occurring. I mean, the pandemic has essentially catalyzed 5 years of adoption in 2 quarters. I mean, let me repeat that. 5 years of adoption has happened in 2 quarters. Putting some numbers behind it, e-commerce as a percentage of total retail pre-COVID was around 18%. Post-COVID, people think that number is like 23%. That might not sound material, but when you apply that to the approximately $5.5 trillion retail market, I mean, that's a massive shift. And the lockdown and the associated acceleration of adoption has proved people are willing to buy anything online given the right experience. And that includes everything from groceries to furniture. And there are too many topics to cover here, but I'll highlight 3 core trends that retailers were focused on pre-COVID and then have really gone into hyperdrive. And that is, true omni-channel capabilities. The second is the transition to the cloud, and third is enhanced data and analytics. And I'll give 3 quick examples because I think they're helpful. Every retailer in terms of omni was focused on how do you improve that consumer experience, whether it be online and in store. But since COVID, that's become a do or die situation. Before it was on every quarterly business review, on every board meeting, but now it has to be there. It has to be parity in order to compete. And those initiatives are now receiving larger budgets. As an example, we saw a retailer that had 90% of revenue in store. Obviously, after the lockdowns, that went to 0. They had to furlough over 80% of the company. The only team that got more budget was the digital team. And as you think about digital and omni going forward, really we have to spend a lot of time thinking about the team and capabilities. I caution a lot of people and a lot of executives about outsourcing digital marketing and development. It might make sense because budgets are strapped in order from a cost perspective, but if going forward, that's where you're going to compete, you probably want to own it. The second is cloud. If you're a legacy retailer, and I'm talking, pre-2005, most likely you have a number of components that are not in the cloud or a patchwork of systems that don't integrate well together. So we're seeing a lot of companies, how do you accelerate that move? But we see a lot of issues because companies don't fully move to the cloud because they don't have the resources and capabilities to do that. And as you continue to think about scale, bolting on, and the next part, which is data and analytics, you really have to be in the cloud in order to move quickly. And then really lastly, does the management team know their gross margins by product, by channel? Do they know which ads drive the highest revenue per basket? Do they know their e-com shopping cart abandon rate? Most retailers we work with don't know those numbers readily or have to take, a week to compile those numbers. If you're competing, we have to remember we're competing in a micro-transaction world now. Consumers make purchasing decisions in a few clicks. Market environments change, daily. And so retailers really need to think about their systems and their teams in order to survive in this new retail paradigm.
Absolutely. So Isa, what does this shift to e-commerce mean for traditional brick and mortar retailers? And are there implications for the future of commercial real estate as well?
Yeah, so the shift to e-commerce is yet another example of the pandemic spinning up trends that were chugging along before. And while e-commerce presents many great opportunities for so many retailers, it also creates monumental challenges for those who have too much stores, too much space, and a poor multi-channel proposition. If you think about it, overnight, you're having millions of people converting to online shoppers. And one of the things this creates is it sends shipping costs through the roof. And these are costs that retailers have to absorb. And you add that to a couple of weeks of lost store revenue because the lockdown, is a recipe for disaster. So even though department stores want to try to go online and try to, adapt to the changes in the market, that's not going to solve the underlying issues of their business models. And then you have companies like Target. Target has invested heavily to reimagine its business in the digital world. They've invested in new and contactless fulfillment options. They do same day or next day delivery. They've remodeled some of their stores to better fulfill the online demand, and even added more space for curbside pickup and things like that. So in a space or in a moment where you have brick and mortars really struggling with keeping up with the fast pacing change in the retail landscape, you have companies like Target who have seemed to really hit the bullseye, because they're using not only stores that are no longer relevant to repurpose them and use them to fulfill online or digital sales, but also they're trying to keep up with the demand of consumers because they want convenience and they want speed.
So you mentioned Target. Thinking about them and other massive stores that next Friday, believe it or not, we're almost a week away or 2 weeks away from Black Friday, which is historically one of the more active shopping days. So Tom, how might this holiday shopping season look compared to other years, given that we are in this pandemic? And how can retailers best prepare?
Great question. So as an operator, that that inability to plan around Black Friday, Cyber Monday as an anchor is one that concerns me the most as I look at how this may shake out in the next few months. Because, you know, if you look at apparel retailers, you've got a product cycle that could be 6 months, right? And depending upon whether you believed at the outset of the pandemic that this was a 1, 2, 3 month, or, you know, what it turned out to be a 10-month plus event, would really dictate how you planned around this period of time. So that planning was typically done late spring. So putting that aside is a genuine fundamental concern that I have industry-wide. You know, it's probably never going to be the anchor that it was. The demand, if you look at Amazon's Prime's Cyber Day, which is October 13th and 14th, ended up being about a $10 billion day. Everyone needed to react to that. So you saw that the massive retailers kind of that are always in that same discussion, they started with their Black Friday, if you will, promotions back in October. And if you're going to do that, you need to really remain interesting, right? So you can't just call it that and have people show up and see the same message. The message has got to change. The product's got to be fresh. The value has got to be there. So for the ability to really plan on that and have Black Friday do what it was, going back decades, what it was, you know, get retailers into the black, those days are gone. And it'll be very interesting to see. I just talked about how demand was pulled forward into October. How much of that demand was actually pulled forward even further back when people were just at home in front of their computers and said, you know what, let me get online and do some of this shopping now. It'll be very interesting to see how that plays out. But this is a benchmark or a tentpole going forward. It's not going to be that important as a measuring stick going forward. It's just not.
So you mentioned online shopping. Retailers are continuing to add these shopping and logistic capabilities. Nevin, how will this year be different? Are you seeing these capabilities be integrated in-house, or are retailers using outside partners?
I think retailers are continuing to use outside resources, whether they're consultants or extensions of their teams. It's just a function of speed and cost. It's something that retailers need to think about long-term if this is going to be a differentiated part of their business or a core channel and strategy. Do they need to bring that in-house? I mean, the largest thing I've seen as a wake-up call for retailers is over the past few months, companies wanting to own their consumers or own the customer. And what I mean by that is retailers who sell through big box or through Amazon now realize they're ultimately at the mercy of those retailers. So we see clients that have never had a DTC component of their business gearing up to launch a website just so they can have that brand recognition and not be at the full mercy of the retailers. And, you know, one of the largest differentiators we've seen at STP or Sierra is how holistic management teams and lenders are thinking about a turnaround situation. So it used to be relatively straightforward, right? Let's come and do financial or operational restructuring. Now we're being engaged not only help with those core, you know, blocking and tackling, but also strategize and work on elements related to launching new revenue channels like white labeling or direct to consumer websites. So it's fascinating how it's kind of evolved. So retailers don't have to rely so heavily on big box and Amazon.
Mm-hmm. So Isa, this next question, expanding on that, are you seeing retailers approaching their relationship with shoppers differently, the way that they engaged? And what kind of new technologies might they use to reach their consumers?
Definitely. And here's the thing, Katherine, because before the pandemic, the e-commerce story was pretty clear. It was mostly geared towards younger, tech-savvy generations, and the products were focused on friendly delivery stuff like electronics and clothing. But as we've been discussing throughout this panel today, we have seen how many families started to do online grocery shopping and things like that. But most importantly, older generations started to realize that buying online is not only a viable option to, fulfill their many needs, but also it's convenient and safe. And I see this with my dad because he used to refuse to buy online, but he's high risk, so now he does it. So this is really important because you're having a new profile of consumer emerging from the COVID-19 pandemic. And there's even studies that show how these people who perceive the COVID as being very high risk are 4 times more likely to shift their consumer or the shopping behaviors in the long term. So with that being said, and with this in mind, and as Nevin was saying earlier, I believe like data science, artificial intelligence, and machine learning will be at the heart of identifying these new customers and engaging with them in like scalable and automated ways. So even more than that, you have to think about it because the way you need to engage with these older customers might not be the same way you engage with the younger ones, because older people may prefer free but time slots or time delivery slots, while younger people don't mind paying a premium for a same-day delivery. So more than the technology, you also have to think about how to adapt all your marketing and advertising strategies to target and adapt to the new normal.
Mm-hmm. We have a question actually from the audience that I'll ask to the panel, and anyone feel free to jump in. So the question is, many companies, and the example used is food suppliers, went from selling to businesses to selling DTC during COVID. So how durable will this trend be if/when the pandemic fades?
I think it's durable if the following condition is met, as long as they can meet the expectations of the consumer. And that's where it talks about, when Nevin talks about getting into the data, figuring out what the consumer tolerances are, for instance, right? So if you get in and you study, okay, what's the tolerance of this consumer for the number of steps in a checkout process, right? Is 1 too many steps enough to alienate this consumer? What is the tolerance for a wait? Are they willing to allow deliveries in the case of the example just given? Are they willing to allow those deliveries to be batched, or do they have a 1-hour expectation? Is a 2-hour expectation, right? What is the range outside of the store that the store is willing to actually satisfy deliveries or whatever the original source may be? But those kind of tolerances, if they're studied and met, and the expectations of the consumer are met, then it definitely has legs and it's sustainable. But this, the best of the best have set the expectations. The Amazons of the world have set the expectations in terms of service. So once people engage in that, they have to be really, really on top of it and make sure that they don't disappoint the consumer, because you don't get to do it twice, quite frankly.
Yeah, I think to extrapolate on what Tom said is it comes down to branding and convenience, right? So after this, the lockdown or the pandemic ends, and consumers have the ability to go in store, is it still more convenient to buy it online? And do they have some brand affinity or connection to the company that's selling it to them? I think those are 2 lasting propositions that companies need to continually focus on, because as Tom mentioned earlier, right, if you have to think about your refresh of your product base, of your offering to consumers, to make sure they are enticed to come back to your website and click through.
Mm-hmm. I have another question for you, Nevin, too, about changes that have occurred with respect to the adoption of new payment methods and financing options. What kind of impact will that have on retail profits, and how will these methods affect retailers' finances? Are there any business structures that are changing to adopt to this trend?
Yeah, thanks, Catherine. That's a great question. And every participant on this call should have heard of Afterpay, Affirm, and Klarna. If you don't, there are major implications from both the management, legal, and financial and investment side on all 3. Afterpay is the large, is listed on the ASX, market cap over 20 billion. Affirm's gearing up for a $10 billion IPO. Klarna was just valued at 10 billion. They're the largest fintech unicorn in Europe. These are all the new fintech darlings transforming the layaway or installment payment business. So making it much easier for consumers to purchase large ticket items, or essentially smaller items they just don't have the credit for today. So think about Peloton. I think they partnered with either Affirm or Afterpay. I can't quite remember. So you don't pay for the Peloton up front. You pay over installments, no interest fee. And Peloton on the back end is essentially compensating Affirm or Afterpay. I can't remember which one they work with. And these are all important for a couple of reasons. One is it just reduces friction. It's very important for retailers to realize conversion of your cart is incredibly important. If you can reduce the friction by just 1 or 2%, the numbers add up very, very quickly. And I think on the back end of that issue, many issues are struggling, and it goes back to Black Friday with how they deal with returns and chargebacks. So, on the return side, many retailers don't have the infrastructure or the data or the pricing sorted out to really handle the influx of online returns. I mean, if you go into any Kohl's and see their return center, it's chaotic. I mean, because they're accepting Amazon returns in store, they're accepting their own returns, but people go in store to do it because they're getting offered to do that. And then because of COVID's caused all these shipping and delivery delays, that compounded with the ease of how consumers can now dispute charges on their credit card. I mean, we see millions of dollars of chargebacks happening to retailers that are occurring after 30 days. So these credit card companies are now letting consumers charge back much later. And so we have to think about, from a retailer's perspective, do you need to have a team in place someone on the finance team who's dealing with these chargebacks? And how do you have policies in place to mitigate that? Because it ends up just eating basis points off your gross revenue, and ends up obviously filtering down to the bottom line. So a couple things for people to think about when it comes to payments.
Mm-hmm. Absolutely. And there's more changes to come, especially with the upcoming holidays, which we started to touch on. And this year is going to be different than others. Traditionally, the fourth quarter is the biggest selling period, or the biggest purchasing period for consumers. So Tom, for struggling retailers, even outside of COVID, but given that we're in the pandemic, if retailers aren't able to attract customers the way that they have in the past, what options do they have? Are there tactics that you've used to help struggling retail companies in the past, and will some of those strategies work in this current environment?
Sure. I mean, as we've talked about a couple of times, I mean, as Nevin said, I think perfectly, the compression of 5 years of transformation into 2 quarters is not even the least bit of exaggeration, right? So if we have clients that or projects that we're working on that are even a week or 2 or 3 behind that, that's where we're going to focus quickly. The areas that folks really need to get comfortable with, and I can't emphasize this enough, is on the data side. If they have never owned their own data and gotten into harvesting that and what that means and wrapping their arms around their consumer, right? And talking to them in a targeted way so that when they engage, the message to that consumer is a personal one. So I don't have somebody reaching out to me as a 50-year-old man and offering me something in an email that's completely absurd. It just tells me they're not paying attention to me, they don't care, it's offensive. In this day and age, that's totally unacceptable. So we engage on things like that. As long as the cost structure of their business, I can guarantee in the calls that we're going to get, the cost structure has been incrementally improved. It can still be significantly improved. Looking at things like, I know this doesn't go to your customer question, but I'll get back there very quickly. Looking at things like whether or not you handle logistics internally or externally, outsource. This isn't what your core business is. Your core business is not IT. Own, as Nevin said, own the digital experience, and we're going to have to lean heavily into that. But the IT development, the red flags that I see with the sunk costs there have created a lot of the headwinds we talk about right now. But the tools in order to get it that enable companies to get themselves back on track and back as participants if they miss a cycle are unprecedented. So we can turn an organization that is moving in the wrong direction more quickly today than ever before, because we can deploy those digital tools. We can deploy the best practices that we've developed and we study all the time. And it's all wrapped around that consumer data, knowing what the preferences are, embracing those preferences, being agnostic as to how she wants to engage with you as a company, and just leaning into that and making sure that the consumer experience is really off the charts. So all is not lost. This is the time where a lot of these things should have been taking place, but if folks are behind, there's still work that can be done.
Yeah, Catherine, I think the best example of that is Walmart. Last night Walmart posted better than expected third quarter earnings on the back of 80% increase in e-commerce sales. And Walmart has been focusing on digital. They've invested billions of dollars over the last 5 years, and now that's coming to fruition, and they're able to move agile in a pandemic. So for all those retailers who don't have that bankroll, you've really got to be nimble and really got to think strategically of where we're going to invest that money to make most bang for our buck. And as Tom just said, don't invest in supply chain. There are other people who can do it potentially better and leaner, but then focus on brand, focus on your product, focus on other core elements of your business, because this is only going to compound faster. And I think that's the thing that retailers have struggled with over the last 5 years is when you're seeing e-com or your revenue or whatever decrease by basis points quarter over quarter, it doesn't elicit you to make that change that you need necessary. And now COVID has really, obviously thrown up the flag, and everyone knows it has to happen. And so really thinking really methodically on how to improve that. And I think to answer your core question is, I think Q4 is going to be a winner for those companies that have invested in it, created convenience, created brand, whereas other companies will be the detractor.
Mm-hmm. Isa, what about?
Can I get just one last thing to that, Catherine? I'm sorry.
Absolutely.
But one last thing. So I'm sitting here as an operator, right? So if there are any operators on the phone who are going to listen to this down the road, do not sit paralyzed thinking that, oh my God, I need to build this infrastructure to be able to do all these things that I hear these people talking about. Or even if you're a lender sitting with a company in the portfolio that you feel as though is fallen behind where they should be, and that the build out of all of this, don't think of it that way. The processes, the products, the systems, they all exist. So the ability to deploy, implement, and execute on those, I've been doing this for a long time. We are in a completely different time, and our ability to turn things quickly in this environment is unlike any time before. So there are things that can be done.
Yeah, and I think just to add on that, Tom, which is a great point, is that we're working with clients today, never had a DTC presence, have nothing in the cloud, and we're able to move their payroll from a legacy ADP system to a cloud-based server, move all HR to a cloud-based solution, create a DTC website, and create the whole value chain from front to back in less than 6 months. Right, a playbook, and not adding a ton of resources in terms of people. I mean, that's an incredible turnaround. It's just you've got to think through it beforehand and make those logical steps and work with your stakeholders, including your lender's board of directors, to make sure everyone's on the same page to actually achieve those end goals.
And for those who aren't familiar with that term, DCC, or the acronym, can you just
direct to consumer. So most companies we work with or we have seen or come through have been selling through to Target, right? They're the category leader for art or home decor or dishware. They've never really had their own website. They never sold the consumer directly. Now they have to create, they want to own the customer, own the data. So they want to create a DTC channel. So they want to create their own website, have a direct to consumer approach. So people can buy on the website if they want to, or ask customer service questions or whatever they want. It adds a new element to the business because you've got to create all those processes, the infrastructure, and the people to handle all that. But there's a lot of dividends to creating brand value down the road.
Mm-hmm. And Isa, we've talked a lot about online channels. What about brick and mortar? Is there a way to engage with customers in this time in a safe, profitable way? I know it's not going to be the same profit, but is there any opportunity there to engage with a customer?
Yeah, so if you take a look at the bigger picture in real estate, one of the biggest issues right now is that retailers view their lease obligations more like pinky promises rather than actual binding contracts. And this is an issue for property owners. And even you see how Simon Property Group is engaging in litigation with some of their tenants because he's trying to collect these overdue rents. And for when department stores go down, they can take entire ecosystems with them because department stores account for around 30% of the total mall square footage in the US. And we all know where they're heading, or most of them at least. So one, landlords cannot take that many concessions because, for them, this means defaulting or, on mortgages, on mortgage, tax payments and insurance, and that can lead to even worse consequences. So We also saw last month how CBL, owner of over 100 US malls, filed for bankruptcy themselves. And this is unprecedented because they are the first mall property owners that is joining its tenants on the Chapter 11 club. So property owners need to start thinking about new ways or new lives to give to all these dead spaces and dead malls. And this can take many shape or forms, but think of unrelevant or oversized stores. You can repurpose those to fulfill online sales. Think of like click and collect locations, or maybe even destinations, drop-off destinations for returns or things like that. So they have to be creative and get creative, because the reality is that a lot of these businesses are gonna either, slide into bankruptcy. They might go out, or they might just become less relevant.
Absolutely. All right, we have a few more questions actually coming in. I want to remind everyone that we are taking questions throughout this conversation. We will not be holding for a Q&A at the end. Rather, we'd like to make this an engaging discussion. So with that, and still on the topic of brick and mortar, so which brick and mortar stores do you think will continue to be relevant even after this shift to e-commerce happens? What do you think will move online for good?
Nevin, you want to take a shot at that?
I actually want to take that one, just because we always talk about the shift to e-commerce and how everybody has to move online, but there are actually cases where brick and mortars are still relevant. And one example is companies like Burlington or TJX, who runs TJ Maxx, Home Goods, and Marshalls. These are in the off-price businesses, and the way it works is that they describe it as a treasure hunt experience when you go into the stores and you stumble upon stuff you didn't know you needed. And it's super interesting because Burlington, at the end of the year, they actually said, you know what, we're winding down our e-commerce operations because they just account for 2% of their sales. So for them, at the prices they're operating, it doesn't make sense, or it's not that it doesn't make sense, but having brick and mortar stores are more economically and actually add value. So that's one example when brick and mortar are like relevant to the industry.
Yeah, I think to add on that, the true winners in scalable businesses will need to have both. You can't have just one or the other. If you look at really high-flying direct-to-consumer brands like Warby Parker, they realized after growing and scaling, they needed to have physical locations in order to continue to scale. And on the flip side, you've seen Target and Walmart invest heavily in digital and e-com. Both these things are going to be needed in order to reach consumers wherever they want it, however they want it. So I think it's less about which side's going to be the winner. I think it's about how do you build a convenient ecosystem and true omni experience for consumers.
And there's also in the furniture industry, winners are those that are combining or have a balance between e-commerce and in-store, because I think 75 people look online before going to the stores. Like, you can have many sectionals online, but you cannot beat the seat test. You want to make sure that the couch you're buying is comfortable. So having a balance between in-store and online, it's important for some cases like that.
Nevin, this next question, I think that you would be good to answer. The question is, any advice for retailers that have invested in the technology and infrastructure to help retain and grow customers, given the headwinds that COVID has provided in terms of discretionary spending?
Well, that's the secret sauce. That's why you gotta call me afterwards and give you the debrief. But there's a number of things. I think the thing I've seen most, and I'd love to hear Tom and Isa's opinion on this, is that management teams get really excited, really jazzed about implementing or moving digital or some digital transformation initiative. They implement it, and then there's no resources to monitor, iterate, and expand upon it. And so the number one thing I see is, like, right, you implement a new great digital architecture layer on your e-com sites. You can track all the interesting data related to click-throughs and where people are dropping off, but then you don't have anyone in-house to manage those data analytics and analyze it and bring it back to the team. So those are some of the few things I see where retailers can do a better job of. But I'd love to hear Tom and Isa's thoughts on that as well. If they have any thoughts.
If you don't, I have another follow-up question to that.
Yeah, go for it.
Another question. This one for Tom, since you've worked on a number of restructurings and in-court bankruptcies. This question is: do you think that we'll see a wave of bankruptcies after the holiday season? And how do equity sponsors then decide whether to invest in an existing portfolio company when business valuations are difficult to pinpoint at this moment in time?
Yeah, I'm not going to predict a wave. I think I've done, probably most of the people on the phone have tried to predict that over the last year and a half, multiple times. Sure, we're going to see significant bankruptcies, probably in apparel, post this. Great question about how equity sponsors should be looking at this, though. And here's what I would say, and say quite often to equity sponsors. If you've got a brand, product, or service that resonates, and you can honestly sit back and say, okay, this is a very good idea. This is a product that has loyalty. This is whatever, okay? That you look at it and say, this deserves to exist. And then you come back and ask the next question, which is, do we just have the delivery system wrong, right? So we have something here that is compelling by all measures, but we're just not engaging with the consumer the way the consumer wants to be engaged with, which is the key. It's not how we want the consumer to engage with us, it's how they choose to engage. Then there's a compelling story there to lean into and really look at as a potential further investment going forward. You are able to tell, honestly, pretty quickly now, which companies, which brands, which operating companies have simply lost the right to exist. They've lost their way, they've lost their relevance, despite many, many attempts to reinvent them and cast them as something that they weren't, that people originally knew them for. Those companies honestly have lost the right to exist. And for those, it's time to step back and let the process play out. But for those that are compelling and that have a good data file, they have good consumer engagement, things like that, but they're just making some fundamental missteps when it comes to the engagement and the delivery system, there's a compelling case to be made for further investment. I mean, look, it's 70% of our economy, right? What we're talking about here. Brick and mortar is not going away. It's not going to zero. It's just going to be, engaged in a different way. It's going to play a different role, but it's not going away. It's just going to play a different role, right? So it's just who's going to be the ones that figure that out the fastest. And a lot of people are putting a lot of work, and really smart people kind of ahead of us, right? The mega companies, and we can follow some best practices that they're putting in place. But in terms of valuations, you can't get bogged down right now in projections in a pandemic. I mean, that's just fool's gold. You can't do it. Mm-hmm. You've got to assume some return to normalcy. So stage it in, right? So even if all the restrictions were lifted and you want to say, okay, all restrictions are lifted, so now I'm going to put into my financial model pre-COVID traffic numbers, don't do that, right? Because the consumer is still going to say, well, I have my own personal reservations. So you're going to have to be slowly phasing that in and be very mature about the financial models you build coming out of this. But there's going to be plenty here that's worthy of investment, plenty.
Can you give some examples of both the positive and the negative? So you're saying that there are some companies that no longer have the right to or have missed the opportunity to exist. And then on the other hand, the ones that have done a better job of getting ahead or making those adjustments so that they can exist in a pandemic or outside of a pandemic environment.
Sure. I mean, the obvious one, if you go back to one, when I was growing up, Sears was everything, right? The catalog, the experience. That's where you'd go on a Sunday and you'd walk those halls, and I mean those and you'd just be looking at everything from garden equipment with your dad to everything in between, right? And then then a bunch of companies came along and did every one of those things better, right? And at some point when that happens, if you don't recognize that, and you don't lean into the things that you think you do best and your brands, then you've lost your right to exist, and people have just taken it from you. So that's the most painful, obvious, big example, because it's played out over a really protracted period of time, and it's been tough to watch. The other companies that are doing a really good job with it, if you look at, athleisure right now, it's one that really intrigues me. It's not nothing, there's no eureka in that statement, right? That's been a hot category for a long period of time. But if you look and say, okay, we've been able to decentralize corporate America, that looks like it may be here to stay, and at least in a large part. What does that mean for athleisure when people don't have to go out and buy more formal clothes to go to work and go to New York and Boston? That's no longer what they have to do. What does that mean for that category, right? And how well will people lean into that? And and what kind of growth numbers could we be looking at in those kind of categories? So I think there's some interesting stories out there.
Mm-hmm. Absolutely. Nevin, I have a question about asset-based lending. In this environment, have you seen it recurring in retail situations? If so, what are some of the challenges when it comes to ABL lending in the space?
This for me has been the most interesting byproduct of COVID and the pandemic, is how it's affected asset-based lending. And there's a couple of reasons. One is the supply chain disruption, and the second is demand forecasting is just out the window. So on the supply chain side, the China tariffs went into effect in Q4 2019. So there was some kind of overhang of those issues as people moved to Vietnam, Malaysia, other Southeast Asian countries. Shipping lanes and shippers were bogged down. So there were some supply chain issue disruptions there. Then obviously with COVID, that exacerbated all of that, because in warehouses, you had to be 6 feet apart. They had all new regulation. And so supply chain was definitely disrupted. And the compound on that, demand forecast was out the roof. Everyone would have thought everything went to zero. Then we find out, furniture is actually selling and home decor is selling a lot. As Isa kind of mentioned, anything related to home was selling as everyone redid everything. So everyone was out of stock. So you had some companies that had built up inventory levels or reduced inventory levels, and their ABLs got tripped or were overextended on the ABLs. Most lenders recognized that, were willing to work with the lender. But I think these workout teams at all these banks are, we go on call with all these workout groups all the time. The number one thing we hear is we never modeled out zero revenue. And it's amazing to see that. And so we've seen a number of different things in working with lenders on that. But the ABL side has been fascinating as people rethink business models, rethink their supply chain, rethink their demand forecasting, and how that affects their ABLs going forward. I think it's something it's a case-by-case basis, but has huge implications given how large the ABL market is.
Mm-hmm. Isa, we've mentioned athleisure, we've mentioned home decor, home spending on the home. Are there other parts of the retail industry that you are tracking that you think is becoming more prominent during the pandemic that might last beyond when we get a vaccine one day?
Yeah, so it really depends on whether these behaviors are sustained over time. But I truly see, and Tom was touching this before, the athleisure has been a trend that has, been changing for a while, and now it's intensified, and I will definitely think it will continue. You see how Peloton is making competitors come, like Swift will develop their own stationary bike and things like that. So I think that in that space, that's definitely one of the industries that will and it's here to stay.
Absolutely. So we're getting close to the 10-minute mark. I want to just remind everyone that we will take your questions as they come in. If there are burning thoughts that you have, just submit at the bottom. And otherwise, I'll shift to looking ahead to 2021. And I hesitate to ask this question because it's hard to predict what tomorrow will look like, or next week or next month. So next year seems very, very challenging. But given everything that we've seen in the last 7 months and how things continue to develop, I'd be interested in hearing your thoughts, and anyone can chime in here. on what to expect for 2021 in the retail space. What are we going to see? More bankruptcies? Are we going to see sustained profits from work from home and related products?
We'll see some more. We'll definitely see some more bankruptcies. There's still going to be some shakeout. But what's happening now is kind of a violent way to go through what is otherwise a fairly healthy process, right? So this process of purging, companies purging their portfolios of low productivity, high cost lease, like we talked about, companies learning about what the appropriate inventory levels are for them, how to frankly be crisis managers, and most importantly, really good cash managers, which is what we're often hired to be, go in and really manage cash, right? And these types of people are going to come out as better, people that do come out of this are going to come out as fundamentally better operators. And one is, there is a return to normalcy, whatever that is. And eventually it will be back, it will get back to something that we all recognize. I think it's going to be phased in. I think that the people, there's a lot to be optimistic about. There's going to be some more restructuring work for certain. Going into 2021, it just has to happen. There's going to be a lot of shakeout from this. This is probably a 3 standard deviation event we're living through. None of us could have foreseen this, right? But as a result of that, at the end of it, what's left is going to be a much stronger foundation. And I think there's going to be a lot to be optimistic about. And the consumer experience for those of us, we're all consumers, right? Is just going to improve. And the services available to us and the pace at which we're able to engage in a transaction and deliver the service or product that we asked for is just going to be better than we probably could have imagined. So I think there's plenty to be optimistic about.
And I think something, oh, sorry, Catherine.
No, continue. I want to go on this positive note and then I'll switch to the negative.
I was just going to add on, it's important for managers, investors, and all key stakeholders to think about technology is exponential in terms of adoption, right? You have Moore's Law, you have a number of different things that prove that. But, as a great example, as a thought experiment, I talked with the management team recently, is just think about if drones and autonomous vehicles actually happen in the next 5-10 years, how does that change delivery, right? There are a number of studies that shows if drone delivery takes off in 10 years, and there's a number of companies doing it, your delivery cost per item will drop to less than $1, or and even will continue to exponentially decrease. Imagine what that does to the whole entire supply chain delivery model in your whole category is if you can deliver a single product for less than 10 cents, right? And that's in 10 years, and obviously it's a succession of small wins to get there, but as a retailer now, you have to develop that muscle now in order to even offer that in 10 years from down the road. And so, there's a number of things happening here, and every retailer's investing in it now. I think having a true omni-channel experience is going to be parity. It's not going to be differentiator in 5 years. And as Tom mentioned, if you're not investing in it now, you won't be able to survive. But the ability of both management, equity sponsors, and lenders to recognize that, I think, has been fully absorbed. And we're seeing companies, if they have the will, they're able to turn around really quickly. So we're seeing a lot of positive there.
Mm-hmm.
Yeah, and I completely agree. And Catherine, the retailers that are going through survive through the COVID-19 crisis are those who right now are looking at the current state of the industry as an opportunity, and they act on it. Like Tom was saying, this is the time to see what consumers are doing, how they reacted to these changes. And so regardless what your scenario is to the road of recovery, you have to act, you have to invest in technology, leverage data and all that to continue growing your digital channels, your supply chain optimization, and just adapting. And I think it's worth mentioning or remembering that a calendar year change is just that. Like, there are many stuff that's gonna carry over into 2021. And I don't want to be negative, but cases are growing again and going up again. And if we start closing stores again, it might mean whatever it meant the first time. So cash burn, liquidity issues, and even if retailers do really well in November and December, the real results are not going to be in until the dust settles in January, when we have all the returns, because that's another factor that we even talked about. So it's I'm not going to be negative, but I think 2021 we're going to continue seeing tons of distressed situations.
I also don't want to dwell on the negative, but as a distressed debt bankruptcy reporter, sometimes that's where I gravitate. So I'm curious to hear my question, and actually there's a question that came in that's a little bit more specific. So my question was going to be more about the challenges that retailers are facing now that might persist even beyond 2020, so into 2021. And this question that came in was about the challenges that are facing retailers regarding supply chain management, so fulfillment, orders, that sort of thing.
Well, that's yeah. So that's something we're dealing with every day in our firm, right? The supply chain management, because you're not able to, again, because of the unique nature of this situation. Demand planning is at best a very well-educated projection, right? You can't do it based on what the last 5 years have told you. And you'd be right. If you're wrong, you were wrong within 2 percentage points. If you were more wrong than that, you probably should lose your job, because there was enough predictive data in there so you could be very, very accurate. Here we're dealing with a pretty unique situation. Here's what's going to lead to significant restructurings, and I'm going to speak as a restructuring guy who's been in the room many times. If the debt holders are sitting waiting for the equity holders to move, and the equity holders are sitting waiting for the debt holders to move, and the company sitting in between, the inevitable conclusion of that is going to be a restructuring, probably in court, if they're fortunate enough to have a restructuring. The debt's only going to go so far. The lenders can only go so far into this story. There isn't a whole lot left that you can financially model that would get a lender more comfortable. But if you're the owner of a brand, service, product company, and you go back to what I said 30 minutes ago, and those elements that we've talked about here today exist, this may be the time for the equity to step up and plug that hole and lean into their investment. And I think coming out of the other side of this, there'll be plenty to talk about. But supply chain, I absolutely get it. And it's an issue that's going to have to be shared down the supply chain. The reason why the big folks remain as healthy as they are is because they don't necessarily own it, but they control it, right? So they can reach into their supply chain and get product when they need it, and they can push it back if they were wrong and they're planning for a particular season, or a SKU was wrong, they jam it back. Smaller retails don't have that luxury, but they can develop relationships because they're existential. Their supply chain is applying on them. They rely upon each other. So those are the kind of conversations that are very honest that need to take place, because the number of distribution channels across a variety of products are narrowing. They just are. So I think those conversations, while difficult, need to take place.
Yeah, and I think Tom's exactly right. The inability of the equity debt holders and company to agree on a strategy is going to be the downfall. And I think, something I've shared with a couple equity investors and equity sponsors is you need to think more like a VC. Do you understand what the return on ad spend is across channels for your retailer or your portfolio company? Do you understand the architecture and data systems for your company? I mean, these are key critical cornerstones for a company to turn it around and scale. And most equity or debt holders aren't even asking those questions. Really, the questions they asked 2 or 3 years ago, really about the finances and core operations, versus kind of this next level tech questions and inquiry, which really is going to lead to the turnarounds really coming to fruition and scaling.
Exactly.
I want to try to squeeze in just one last question that came in. There's some others, so we can answer those also outside. But given the time, on the topic of conversations, what are you all seeing in terms of the relationship and the talks between landlords and brick and mortar retailers right now? Are there factors that influence lease concessions rather than litigation?
Tom's going to be the best guy.
Yeah. So at this point, really no. I mean, initially there were some government programs or some funding coming down that people were waiting for and holding out hope for. There were some moratoriums in certain cities on what could be done by the landlords could actually do. Those things are all now in the rearview mirror, and now it's simply a function of economics. So the negotiations, I think, have become much more serious. There are fewer options on the table, quite frankly. There really are. So if there are fewer options, fewer workout options between the landlords and the existing.
And that could be the reason for a lot of foreclosures. A lot of, bankruptcies coming in early 2021, right? To expunge those leases. Tom, is that what you?
Oh, that's exactly right. I mean, if the
Yeah.
conversation stops and it's a good faith conversation between two parties, they're both running businesses, right?
Yeah.
And it just gets, it just run its course. It's gone as far as it can. The third party, you need to get in front of a third party and and have the process play out there. And I think that's we're headed there. And that could be the trigger for a lot of these retailers. Going back to the original question as to whether we're going to see a lot of bankruptcy, that could be it. You could have a portfolio that has such a burden on you that you really can't operate around that. And really the right thing to do is go in and restructure, cleanse yourself of that, and come out. If you have a compelling, business story otherwise, then that's the right thing to do.
Mm-hmm. Well, on that note, unfortunately, we are out of time. We are coming up on the hour. So I want to say thank you to all of our panelists for joining us today. Thank you for attendees and for some awesome questions that came in. The panel has been recorded and it's going to be available on Sierra's website and posted on their social media channels. So be on the lookout for that. And if there are any remaining questions in the audience, I know there are a few that we didn't get to, please feel free to reach out to our panelists directly. Their contact information should be available on the website. You can also contact me if you're interested in getting on my Bloomberg distribution list called Debt Doherty. You can just email me directly, kdoherty23@bloomberg.net. Otherwise, we appreciate you spending your time with us today, and we wish you a good rest of the week and good holiday season.
Great.
And
Thanks, Katherine.
if you have not signed up for Catherine's email, do it, because I look forward to it. Our entire firm looks forward to it. It's awesome, and it's very insightful and really helpful tool for us. So thank you, Katherine, for doing this again.
Yeah, thanks, Katherine.
Thank you.
No, it's my pleasure. Have a good rest of your week, everyone.
Thanks, folks. Take care.
Bye-bye.
Bye.